Welcome to the Way to Build Wealth. I'm Ethan Bloch, and let's learn how to build some wealth. Episode number 12. Welcome to the show. If there's any new viewers out there coming over from wherever you're coming from, maybe WSYK, maybe. New viewer, stop right now. You can still watch this, but pause it maybe and go back last week. Understand those basics before you dive in here, because some of this may not totally make sense to you to some degree, but otherwise still stick around. I'm not covering anything too complex today. Anyway, we're in our journey still understanding the tools a passive investor uses to pretty much pursue the route of passive investment. And I almost forgot. How did I almost forget? It's Thursday, and it's Thirsty Thursday, and I'm super excited about this drink. Pick this up at the corner store. What is it called? Boylan brand Black Cherry Bottle Works. It's an indie soda, according to my buddy Tim. Yeah, how's it look? No? Yes, good. And it's made from, as you can see here, pure cane sugar. That means there's no high fructose corn syrup, whether you like it or not. And let's give this a whirl. Black Cherry. They have a whole bunch of these I think I'm going to be trying. I'm super pumped about them. Wow, that is awesome. I'm drinking that again. So some people might think this is too sweet. I could understand that. You know, I don't love really sweet things, but I really like this drink. If you like black cherry, definitely give this a try. I don't even like black cherry, and this kicks ass. I'm gonna drink it again. So you know what? I don't even like black cherry, but I like this. It's not really cherry-ish. It has some of that in it. It's really just sweet and good. Maybe just to shake it first. No, no shake. Okay, awesome. I'm drinking it again, I think. Sorry, I'm wasting mass time here. All right, let's get into it. Today we're gonna talk about mutual funds. How exciting does that sound? I'm so excited! Today we're gonna talk about mutual funds, and before I get into it, I should say that this is not an approach you should take if you're a passive investor, and the reason I'm covering it is so you don't go down the route of passive investing and all of a sudden fall into the pitfall of mutual funds potentially. And I should say mutual funds in actively managed mutual funds, because we all know from last episode an index fund is a kind of mutual fund, but there's no active management taking place, meaning there's no people, no heads, no suits and ties, you know, actively managing what this fund holds as investments. The vast majority of mutual funds are actively managed mutual funds. I'm more than certain you've heard of mutual funds before. There are so many out there, pushed by so many financial advisors, brokers. We might as well just call them salesmen, because that's what they are. Do they want to send your kids to college or theirs? It's a question I always throw out there. Just saying. Tons and tons of mutual funds. And that's great. Maybe. The bottom line really is, and this is going to hurt a lot of people, mutual funds suck. And you're like, oh, suck's such a terrible word. Well, mutual funds do pretty much suck. And we're going to get into it when we cover this book tomorrow a little bit more. I don't want to blow all that today. But, I mean, that whole book's okay, I'm not talking about the book. Sorry. But mutual funds, you know, I'm saying it again, I should probably be a little bit more intelligent than just the word suck. So, because mutual funds are actively managed, you have fund managers consistently trying to beat the market. There's a lot of things, you know, that are not in their favor. The biggest of which, in my mind, is if these funds start having continued success, and let's say they beat the market for a few years, which is totally possible, totally likely, it's been done before, all of a sudden, more people are going to see that and put more money into the fund, and it's going to be even harder for them to beat the market with more money. Think about it. If you had $10 or even $1 million, it's much easier to get great returns than if you had $1 billion. The more money you get, the more it weighs you down and makes your job more difficult as a fund manager. So in a lot of senses, having success as a mutual fund is in a lot of ways your downfall, unless you have extremely kick-ass management. But again, if you're me and you're investing in a mutual fund which has awesome management, what happens when the management leaves? I've read actually, that the average fund manager stays there for just 5 years. How the frick do you invest for the long term when a fund manager is going to be out in 5 years? That doesn't make, any sense to me at all. And furthermore than that, a lot of mutual funds aren't even around for 20, 30 years. They come up. There were a ton of mutual funds just in the beginning, beginning of the 2000s or the 00s of the 21st century, in 98, 99, that cropped up out of nowhere. They were funds that focused on technology stocks, and they aren't even around anymore. They're gone. They basically sprung up to capitalize on this fad of the new world. The internet's going to solve everything, and they don't even exist today. They're gone. And as I said yesterday with ETFs, the fact there's so many of them creates tons of pitfalls for investors, because all of a sudden you have mutual funds that, let's say, track technology stocks or value stocks. And over the past year or two, they've done really well. Instantly you think, oh, look, I can see these funds have done well. I want to throw some money in them, but you're throwing it in at the height. And what happens next year? It just goes down, maybe, probably. It just, again, instigates you to potentially make extremely poor decisions. As a passive investor, you want to invest in index funds. Don't get caught up by mutual funds. Don't get caught up by flashy returns of mutual funds. 1, 2, 3, 4 years. 4 years ain't shit in life. Who cares? Show me 40 years, then we can talk. 40 years, right? What is 10? What is 5? I'm getting caught. This is a lot of sugar. I probably shouldn't drink this much sugar. I'm getting all kinds of jazzed up here. I'm losing my mind. But going back, passive investors, focus, learn, and understand the index funds. Forgo mutual funds. Don't pay them any attention, por favor. Actively manage mutual funds, that is. And that's all. That's it. Good soda. See you later.